Today we're joined by Reiman from BlackRock to talk about his outlook for the economy and what it could mean for your investments. Thanks for being here, Kurt.
Nice to be here, Sarah.
I want to kick things off and get right into it by talking about your outlook for the global economy and specifically what you think the likely path is for Canada.
Sure. So I would say that the outlook is reasonably upbeat for the global economy. It's primarily being led by fiscal stimulus in the United States. We are seeing some slowing in other geographies, for example, in Europe, also in China, but there are stimulus measures in place there to try to keep things firming. I would say that also in the U.S., there's a little bit of evidence that the housing market is weakening. There's some questions about the durability of some of the manufacturing surveys that we've seen, but for the most part, our signals tell us that over the course of the next 12 months, we're going to see consensus estimates for U.S. GDP growth running at about 3%, which I think is pretty healthy compared to where we've been.
One thing I heard you alluding to a little bit is some potential risks, is what it sounds like.
Yeah.
And specifically, I want to ask you about the yield curve flattening and the volatility we've seen in the markets recently. Do you think that points to something negative in the cards?
Well, yeah, and actually a lot of investors have been asking us about what are the signs that the yield curve is telling us, what is the widening of spreads on emerging market debt saying, the weakness in emerging market equities. There's this view that there's something sinister right around the corner, just waiting to knock the fundamentals out from underneath this expansion. And we don't see anything imminent. In fact, rather, we would argue that the yield curve's a less helpful predictor of future economic activity because of the efforts of what central bankers are doing. We would argue that a lot of the weakness in emerging markets is idiosyncratic. It's around certain events in countries like Turkey and Argentina where their external financing is in difficult shape. But broadly speaking, our view is that this expansion has still some room to run. Where are the risks greatest in our view? Well, I think that there's uncertainty to the upside and the downside. I think there's concerns about trade, certainly weighing on the outlook for equities and other risk assets. That's something that's been notable, and I think financial markets are reflecting that risk in the prices because earnings have been strong, but the market really hasn't gone much in any direction. But on the flip side, and one thing that we don't talk a lot about, is that we've seen this upsurge in CapEx, which is helping really underpin this expansion. If it's invested the right way, we could see a productivity rebound, and that would be very good for financial markets. So there is uncertainty, but we have to keep in mind that that uncertainty is to the upside and to the downside.
So given your context that you've provided on both your outlook and then some of the risks that you're sort of keeping in mind behind the scenes, how would you position portfolios? And if I'd like to start off with equities.
Yeah, so in our mid-year outlook, we took the bold step of taking a little bit of our risk off the table. We thought that given the trade uncertainties and the flatness of the yield curve, that we didn't want to be too far over our ski tips with regard to our exposure and risk. And so we dialed back our overweight in equities, and where we took the positions down were in markets where we had the least conviction. So that would be largely EFA, which is Europe and Japan. We moved to an underweight in Europe, and we moved to a neutral weight in Japan from previously being overweight. We took that and we can allocate that in two different ways. For those investors who may not have enough exposure to the US, which is one of our favored markets, or emerging markets, which is another area that we've been focusing on, we would recommend taking some of the proceeds and investing them there. But I think most Canadian investors are full on their allocation to the US because it's done so well. Maybe there's some still appetite for emerging markets, and why not now after the market has cheapened up some. But alternatively, there is this approach that you can take, which is to put some of that equity budget into fixed income. And the area that's most attractive to us is the short part of the yield curve, where for the first time in years, you're starting to see some value there. You actually get paid in excess of inflation for owning short duration fixed income. So in terms of building ballast into the portfolio, that's one area that we would highlight.
And if you had to look within that allocation or some of the decisions you've made, and you looked at the greatest opportunities or where you see the most room to grow, where would that be?
I would say that the greatest opportunity is still in the emerging markets. And I know that that's going to be tough for some people to hear because of the news flow, but really what we're seeing is, small countries that represent a small share of the emerging market equity market cap. Turkey, Argentina, even to some extent, you would think South Africa recently in the headlines. They have inflicted some contagion on the broader emerging market landscape. And as I said before, yes, we are seeing some slowing in China, but on the flip side, you're also seeing very strong monetary and fiscal support of the Chinese economy. And that market has cheapened up. Earnings are still growing. Likewise, India is another very large segment within the emerging market equity arena. And there too, earnings are decent. The market's cheapened up. So we think this is an opportunity. It's not for everybody, and it's not for the faint of heart, but it's one area that I think has still some of the strongest legs, fundamentals, and return potential in portfolios.
To close things off, I want to ask you about two things that are very near and dear to Canadians. The first is the loonie and your outlook there, and the second is oil.
Sure, and they're actually somewhat related, in the sense that there are times when the loonie will follow the direction in oil prices. I'll start with oil, just to say that not always, but at certain points, geopolitical risk can be a driver of oil prices. And right now, our geopolitical risk index, which follows specifically tensions in the Gulf and 9 other sort of key hotspots, is elevated relative to its history. And it's coming at a time when supply and demand in the energy markets is more roughly in balance. And as I said before, it seems like the global economy is still on pretty decent footing. So demand should remain strong. There's indications that supply will lag the demand growth at a time when tensions in the Gulf are quite elevated. That to us says oil prices should remain firm, if not move higher, which is good news for the Canadian dollar. I would argue that that's also good news for broadly the Canadian economy. I would even say that we're nearing, if you will, the point when we're going to start talking about the Federal Reserve maybe reaching the sort of neutral rate. It's amazing how quickly we got there. But as that discussion unfolds, if the Bank of Canada should start to sort of hint that they would raise rates more than the market is expecting, that's another leg of support for the loonie. So I would say range bound, but at these levels, when we're in the 76-cent range, moving higher seems like that's a reasonable probability. What's the risk? It's all around NAFTA. It's all around the NAFTA renegotiation. It's trade. It's that sort of downside risk scenario that we talked about before. I think the loonie would probably take it on the chin pretty hard if NAFTA weren't concluded favorably, but we think that it will be. So that's another area that provides support to the currency.
Kurt, thanks very much for being here. You've given us a lot to think about in terms of your outlook for the economy, risk to consider, and even asset allocation decisions.
Well, thanks for having me.